Hello, everyone, and welcome to today's webinar, ERTC, the Employee Retention Tax Credit, the latest IRS updates, where we're going to talk through guidance on gross receipts, look-back period, and much more. Joining me today is Terry Kirby, Manager of Tax Filing and Compliance. Welcome, Terry.
Thank you.
So if you're a regular listener to this program, you know that Terry represents Assure on the NPRC, that's the National Payroll Reporting Consortium. This is a group of really all the leading names, including us in the payroll industry, that helps give guidance to IRS, Treasury, Department of Labor, Small Business Administration on how to best and more practically implement the laws that impact us in the payroll industry and impact you accordingly. So Terry sits on regular conference calls with IRS, with Treasury, as a member of NPRC, so she brings a really unique vantage point, and we welcome her today. So just a reminder here. What's at stake? If you listened to us 2 weeks ago as we took a little over an hour really unpacking the details of the Employee Retention Tax Credit, who qualifies, what can you qualify for, what are the rules, how do you get it? If you missed it, highly encourage you to hop on assuresoftware.com/ERTC. You'll see a bunch of resources there that explain it, including an on-demand version of that video that you can watch it and see all the details. The purpose of our conversation is not to teach tricks. This is taxpayer money. We only want this to go to those businesses who qualify, but clearly 2020 and the first half of 2021 is a very, very unique time, and there are businesses that are legally entitled to stimulus that some of this can be life-changing money. And as I've described it before, PPP loans, I think, sucked all the oxygen out of the room in 2020, and I'd say even in Q1 of 2021. That's where the biggest dollars of COVID stimulus were for small businesses. It was easier to get, I think. It was at least less complex to understand. But now that people who were going to get PPP loans have got them, and some of the rules have changed that now you can retroactively get both PPP and ERTC funds back to 2020. The interest is now exploding in understanding what this means. In just at a really high level, if you were a heavily impacted business, you could qualify for up to $5,000 per employee for 2020, up to $28,000 for 2021. So a business of just 10 employees could be looking at a max of $380,000. A business of 50 employees, you're looking at almost $2 million in stimulus. So I'm not saying every business qualifies for this. You got to meet the criteria, but this is really, really impactful dollars we're talking about. So really couldn't encourage enough to get smart on this topic, understand if you qualify, read the materials we're providing, watch the videos, talk to your CPA, because this could be life-changing money for your business. So we're not going to go through all the details we did in the last session. This exact chart is on our website at assuresoftware.com/ERTC. Terry, any just high-level guidance, because what we're talking about today, and we're going to start unpacking in a second here, the latest IRS update in guidance they provided, but any commentary of what we kind of do and don't know for these columns, right? So I think CARES is pretty well understood. This kind of helped with CAA, and still more to come on ARPA. Anything you'd want to high level put here before we jump in?
I think you pretty much hit it. I know that when we reviewed last time, we pretty much went through and we weren't sure, but we had what our impressions were for like the 2021 impact for ERTC, and the most recent guidance that came out, which is kind of nice, kind of confirmed a lot of those thoughts and information that we had. So for the most part, I think we were spot on, and now it's just waiting to see what comes out for ARPA.
Yeah, and I think that's a good way to explain it, Terry. So for those who are regular listeners and you listened to this, to watch this webinar 2 weeks ago, there's going to be some incremental information here based on the IRS guidance. Some of it's going to be confirming information. So it was April 1st, it was 2 weeks ago, that we basically unpacked what was in those 3 columns, right? What was the employee retention tax credit as related to CARES, as related to the Consolidated Appropriations Act, and ARPA, right? And that was essentially based on how we read the law, how our associates at the NPRC read the law and everybody's interpretation. And so what you see now is official guidance from the IRS themselves. So if you think about legislative bodies, right? You get something like ARPA or CAA, CARES that goes through Congress, President signs it into law. Now it still has to be implemented, and the governing agency here in this case is the IRS. And so the IRS basically has to come out and say, here's how you will implement this law. These are the rules that govern. So sometimes these things have some surprises, like maybe the legislators didn't really think through how something would work, and so IRS has to come up with some rules to how to handle it and or even mitigate against it. And sometimes they're just merely confirming what we previously understood. So largely, this is the document that we're going to be talking through. It's 17 pages. This is what Terry gets paid to do, is to read this stuff. Thank you, Terry. But there's 4 big things that we want to talk through. In some of this is validating understanding, some of this is incremental new information. It's the increase in the maximum credit amount for employers, the expansion of employers that may be eligible to claim the credit, the modifications to the gross receipts test, and some revisions to the definition of qualified wages. And then we're going to wrap on the things that we know we don't know yet, that we're still waiting for guidance. So let's take on the first one here. When it comes to the increase in the maximum credit amount, how much new information came from IRS versus just clarification of what we previously understood, Terry? Let's start there.
I would say that the majority of everything that we put out there was confirmed. There wasn't really much in the guidance that surprised anything or anyone with regards to the increase. This one pretty much just clarified that, unlike the 2020 pieces where you had the $10,000 of eligible wage and 50% of, that being the maximum credit for that whole period, this one identified that it goes up to 70% and it's now $10,000, wage maximum per employee per quarter. So this one, I think we were really interested in this last time. And so I think for the most part, everything that we saw pretty much was clarified. So there were not any questions and we were really spot on.
And to be clear, this guidance is this guidance on, in this is where it gets confusing. Is this the most recent update from IRS specifically talking about retroactive to CARES, or is it only implementation of the CAA that passed in December 27th?
This basically was part 2 of the CAA release. The first notice that we had that was released in March that it added to the fund when ARPA passed was guidance on how to handle tax year 2020 based on the legislation passed in December of 2020. The legislation, the CAA, in 2020 that was released, they did not address in the last notice how to handle anything for 2021, which then that's why we read the legislation. It came up, this is what it says for the credits and the maximum amounts. This was the guidance. This new notice provided guidance on how or what the actual changes were and for the limited periods. So this one identifies that this increase in the maximum credit extends for the wages paid after December 31st, 2020 and through June 30th, 2021.
Got it. So CAA covers Q1 and Q2 of 2021. And so if you attended 2 weeks ago, you know it. For those who didn't, Terry, save a little bit of time, just walk through what the 2020 maximum credits are and what the 2021 maximum credits are.
For 2020, basically through CARES, and then also with that expansion for those employers that are eligible, for that tax year, $10,000 of eligible wage per employee was out there depending upon the eligibility of the employer. Keep in mind, it's the employer that has 100 or fewer employees can use most of the wages that they paid their individuals. Employers that had over 100 employees, they needed to designate, wages that were paid for not service items, and that was, a total of $10,000 for the year. That included employer qualified medical care or health care benefits, and it was 50% of that. So you could actually get $5,000 per employee for those that qualified. Now, with the change for 2021 and these first 2 quarters, that was expanded to 70%. The subject wage for those employees went up to, or is still the $10,000 amount, but 70% of 10,000 becomes 7,000. You've got a $2,000 increase, but that's now per quarter. So that's a significant increase. With that, the employee count changed, so that then it expanded to the employers from 500 employees or fewer, and then those with 500 or more. And the types of how the wages and the qualifications. Keeping in mind that there's still in place the item that you had to show that there was a reason for the shutdown, or you had gross receipts that were reduced.
Right. Okay. One of the nice things, so there's the obvious positive news for the 2021, and to be clear, we think we understand the entire year based on both CAA, which covers Q1 and Q2, and ARPA, which covers Q3 and Q4, though we are still waiting guidance from IRS on Q3 and Q4 based on ARPA. So, but we think we understand it, right?
Correct. ARPA, there's some verbiage changes, and that's kind of why we're sitting tight on that. They're looking at what wage bases we're looking at, Social Security wage bases versus Medicare wage bases, and information like that, because I know it also impacts the original FFCRA and the sick and family leave, and whether or not does it reset for the total balance or not, because we know that it didn't for the beginning of the year, but now it may have, and so there may be requirements to have separation in reporting. So yeah, the next legislation to look forward to for update is ARPA, because there might be some fine tooth comb hairs and such that we need to go through that may be altering some of the information we have, but for the most part, what we have and what's been communicated pretty much is what we've got out there for now.
Yeah, and one of the, so obviously the bigger dollar amount, 70% of 10,000 per quarter in 21 is obviously a lot more money than 50% of 10,000 wages for all of Q2, 3, 4 combined in 2020. But honestly, from an administrative perspective, it's also going to make reporting a heck of a lot easier, right? Because you're going to calculate your eligible wages within the quarter for, say, Q1 of 2021, and if you're gonna hit your $10,000 cap or you're not, you're gonna get 70% of that, right? Where 2020 calculations are much more complex because the $10,000 cap is based on an accumulation of qualifying wages over a 3-quarter period.
Correct.
Right. Okay, so 5,000. So it is kind of what we thought last time. It's validation, $5,000 max credit for 2020 for qualifying employers, 7,000 per quarter for 2021. We are still awaiting guidance for ARPA. Presumably, we got the big boulders right. We're the 70%, up to 10,000 per quarter. What employers are eligible. What is yet to figure out is kind of the makeup of qualifying wages, especially with changes that ARPA made to things like COBRA, correct?
Correct. Very
Yeah.
much so.
Yeah. All right. So we'll come back to that when we wrap. All right. So number 2, the expansion of employers that can be eligible to claim the credit. So let's start the same way we did our last topic here. How much new information did we get on April 2nd versus validating information?
The information that we had for the most part was exactly what we expected. The expansion that I think that we didn't actually call out was that this also allowed colleges and universities that are like government entities that have hospital and medical care. They were not eligible in tax year 2020, but then became eligible in 2021. That's the only piece that we didn't really call out for the most part. But the expansion of employers based on the employee count and the information on how they're eligible to claim the credit, pretty much we called out exactly what we saw in the legislation, and this guidance pretty much confirms that.
Okay. And so just again, we won't take everybody through it. If they want all the detail, they can just hop on suresoftware.com/ERTC and they can watch our previous like an hour and 5-minute conversation where we went into the details. But just to kind of Reader's Digest version, kind of recap who is eligible for and break down the difference, I guess, between 2020 and 2021.
Yep.
Are you, Terry? Can you? Are you good? Can you just break that? So.
Oh, I'm sorry.
No worries. So yeah. So there's no material change for those who have not seen the previous webinar or studied it
Correct.
yet. Just really high level. Can you break down which employers are eligible for 2020 and 2021?
For the most part, employers that had a reduction in work based on the executive or government orders and or employers that had gross receipts reduced. In this case, with the change in legislation, the employers that had 100 employees was the guideline for 2020. For guideline for 2021, it's now whether the employees had 500 employees or more, so that they, or fewer than 500 as well, to be able to determine how that they would be able to compute the actual types of wages so that it would make them be eligible employers. But for the most part, guidance that we provided indicating that they had to have either a government lockdown order and or changes in gross receipts that were less than 80% of the same compared to tax year 2019 were pretty much those employers that would be eligible.
Terry, we're going to go next slide. We're going to talk more details on the gross receipts test. What can you share about the government shutdown? So if I'm a restaurant, I've got one location, and my mayor, county executive, governor, whatever the case may be, literally just shut me down for a period of time. That's really black and white, right? But
Correct.
For businesses that maybe have multiple locations, one location was shut down, another one wasn't, or maybe I have front of house employees that were shut down and restricted, but I had back of office administrative staff, maybe it's software developers, maybe it's finance people, HR people that weren't impacted and could work from home. How should people be thinking about whether they do or don't qualify based on the government shutdown test?
Well, if it needs to be able to indicate or see that there was a significant impact to the business. Now, if there was no impact to the business and the employer opted to just close because it was an inconvenience, they are not eligible um, because they were not able to do business. For the most part, the employee retention tax credit is the ability to pay an individual because they can't perform services because the company is not able to perform services. Um, for the most part, if you weren't impacted because you were able to continue doing business as usual with your staff, whether they be at home or not, your business was not impacted by the government shutdown per se. And so the eligibility of wages normally for the 100 or fewer employees last year was looking at, am I a small business and do I have that impact, and am I paying those employees to work? But for the employer that had 100, it was, what am I paying those employees for not working? And this would not include vacation, sick pay, PTO, and those kinds of wages that you might pay that an employee might request because they're unable to work. These were specifically wages paid because they can't work, not for performing services. So that's something they have to look at when you're looking at this credit. Additionally, that's why they indicated also the next phase, which is the gross receipts ruling, because if it didn't impact the business, then you need to look at, based on that employee count, where do I qualify? Do I qualify? Um,
Yeah, let's go ahead and jump to that. I think we're going to need probably a whole nother webinar just dedicated on this impacted, because I think it's probably the Pareto principle. It's 80% of people who are impacted. It's going to be super black and white. There's probably 20% of people impacted. It's going to be somewhere shades of gray. And so we probably need to have another discussion just solely on that topic. But I think the more black and white where you're going with this is the modification of the gross receipts test. So just talk us through that.
Well, the qualification initially, we'll go back and say for 2020 and the original CARES and that first guidance ruling from CAA, the basic piece for the gross receipts said that you need to look at a comparable quarter for 2019 for a business. If there are less than 80% of your gross receipts compared to your prior period, matching quarter to quarter, first quarter of 2019 to first quarter 2020, I lost or I had a reduction of more than 80% of my gross receipts, well, then I have a significant change and then I was eligible. Now, with what is going on, they're looking at saying, okay, that's one. Look and see how else it impacts it, because now we've got, I don't want to compare this one with ARPA, sorry. It's looking at, if I didn't have 2019 eligible periods, what do I have? If I was a company that started in 2019, what can I use as an eligible period? But we're still looking at, how did it impact the gross receipts of the business, so that you show that there is that significant increase. And then when did I actually come back? And I want to correct myself, because I think the initial was that the gross receipts were less than 50% of the same period. Now
Right.
there's looking at the 80%. So now we've got a little bit more drastic change, but it's also looking at, when did I hit that 80%? The first ruling said, when I hit 80% or more, then that's the end of when I can start, I can ask for those employee retention credits, because now I'm back on the mend and I'm supposedly, my gross receipts are going back up and I'm recovering. What happened with the CAA, especially for what we were looking at, is that when and how do we apply that? They're still looking at whether or not, how do I want to say this? How the election of the first two quarters is applied, because in this case, we've got the gross receipts. You still can show that I have a significant decline. I'm still going to be monitoring how my gross receipts recover, but now I've got that gap period. So I'm still looking at whether they were fully or partially suspended. I've got the less than 80% gross receipts. What were my prior gross receipts and how to get back into it. So the calculation is being a little bit more defined because they've kind of started going into details, if or then what steps do I need to take. I want to see if I have my little notes on that, because for the most part, yeah, greater than 80%, we got that. The most part, what it did in this particular guidance is it actually started indicating if I don't have a first quarter 2019 to compare to my first quarter 2020, and in this case, my first quarter 2020, and then first quarter 2021, what can I use? And so they started defining, if I can't use first quarter, then what is my next quarter period? Can I go to the second quarter and compare the second quarter? And if I don't have that, when did the business start and how do I do my look backs? So that's kind of what the big change for the gross receipts test was, because we had a lot of new startup companies come in at this time as well that didn't exist. So I don't have a history to compare to. And so they started providing guidance for how to look at, instead of looking at 2019, let's look at 2020. Did you have a first quarter 2020? What was your gross receipts then? What is your gross receipts now for 2021? Do you show an increase? Do you show a decrease? I think they're hoping that everybody's going on the increase, but so that we can match period to period. And then if we don't have a period to period, then what was the nearest period that you had, and you can compare. So it's starting to get a little bit more detailed in how to compare to determine the qualification of your gross receipts.
One of the things that I want to bring some clarity to, I think there's been confusion on, I think some folks think either I do or don't, as though it's binary, qualify for all of 2020 ERTC. They understand, I think, that it's quarter by quarter for 2021, but this really is a quarter by quarter qualification, right? And if I qualify, so if I qualify for Q2, let's say Q2 of 2020, I was not forced to shut down. Maybe I'm a business that could just send everybody to work from home and I didn't have a disruption, but my gross receipts were impacted more than 50%. So I qualify for the gross receipts. But that doesn't mean I automatically qualify for ERTC for Q2, Q3, and Q4, correct?
Correct. You have to look at each period because, for instance, when you've hit under your 50%, you qualified. That was good. But then the next quarter period, we need to know. And the period that I hit that 80 or more percent, in most cases, we're looking at that. That means that the beginning of that following quarter, you're not eligible anymore. Because your gross receipts are showing that you're on the incline now instead of the decline. And so now that you've met that 80% going forward, it would disqualify you for the beginning of that next quarter.
So if I meet the 50% threshold for Q2 2020, I'm automatically qualified for that quarter, Q2 and Q3. But if my Q3 I am, say, 79% recovered, but not 80 or more, I still qualify for Q4. But if I'm 80% or more recovered, I do not qualify for Q4. Do I have that right?
Correct. Because it's going to look at your gross receipts, and then the beginning, that first date of that new quarter, you've no longer become eligible because your gross receipts are on their way up. You hit 83% or whatever. That means the first day of that next calendar quarter, don't even include it.
Yeah.
The 79%, you didn't make it, you're still good. The 83, you didn't.
And so the earlier slide that we kind of flashed in the beginning, it was meant to get people's attention for a reason of what we're playing for here. These are really big dollars. I also don't want to overstate this. If you're a business that you let's fast forward to 2021 here. If you qualified, say, for Q1, because, and we're talking about the gross receipts test, but so that's 70% of up to 10,000 wages per employee, so that's 7,000 per employee. But and you qualify for Q1, that means you automatically qualify for Q2. But if in Q3 your business is recovered to greater than 80% prior period compare, then you're done, right? And I'm assuming, based on just looking at unemployment levels and looking what's happening in the economy, and none of us has a crystal ball, but it's clear the economy is beginning to open back up as the vaccine, we're getting a couple million people vaccinated a day here right now. The theoretical potential is 28,000 per employee. That's 7,000 per employee times 4 quarters. But I think everybody should have tempered, realistic expectations that as the economy improves and businesses improve, there probably will be fewer people qualify, especially in Q3 and 4. Is that how you see it?
Exactly, because your gross receipts today tells you if you're going to make it tomorrow. That's exactly it.
Yeah, that's right. Okay. All right. Last one here. And this, I think again here there's more validation than there is new information here. But what did the IRS update tell us about what if any revisions to qualified wages?
Well, for the most part, I think we were pretty much really right on. There weren't any real surprises for the definition of qualified wages. They're still looking at, wages paid that were during the period. They're still looking, we expanded the employee count again. It's all these other elements that added to it. They did remind us, expanded the employees count, the number count that you could have. They reiterated, what you can get an advance payment for. For the most part, they, are reducing that, but they're still applying it against your employment tax liabilities. For the most part, I think the biggest pieces were actually the other elements that add to or go into the definition and how you calculate what's qualified wages based on your employee count, so that you can determine whether it's all wages or if it's wages paid for non-work. They did chime in a little more about some of the I want to say some of the PTO, but I don't even think it really even made that big of a deal in this last guidance, because they pretty much hit it last time.
So
Terry, for the most part, there wasn't a whole lot of a change from what we've previously said.
Yeah, so qualified wages is basically all regular pay, so long as you don't double dip. You can't have any FFCRA credit pay. You can't have any PPP paid payrolls. It's regular pay plus, which would include, tips and commission and all things that are regular pay, plus healthcare, really, and that's pretty much it, right?
Yep, pretty much. Exactly.
So I think it's a good transition to the what we don't know yet. So why is it so this interim guidance we got from IRS was specifically validating the CAA. Correct. Why is it that we can't say with certainty what qualified wages are for Q3 and 4 as it relates to FFCRA?
Q3 and Q4 were addressed under the ARPA, the American Rescue Plan.
I said FFCRA, I meant ARPA, correct.
Yeah.
Too many acronyms.
Yeah, exactly. And ARPA, while trying to expand or provide additional information, they have added a number of other variables that we have lots of questions on. We know that they've made it available. These are based on wages that are paid July 1st through the end of the year. So we're looking at that. There's nothing in notice 2021, 23 for that period. We know that they're looking at how COBRA impacts the benefit of having individuals that, you know, were separated from a company with, not voluntarily, but, you know, for leave or whatever, they didn't have enough hours or they had to be terminated. The election of COBRA coverage, how that can become an item that is provided to the employee without expense for a period of time, and how the employer is going to be able to claim that credit. Um, we've got the impacts of the resetting of the FFCRA sick and family leave limits. Because before it was just, here's the total for the whole period, and that rolled over into any FFCRA sick and family leave in the first and second quarter. But now we've got that gray area that they reset the limits so they could start again. ARPA is also indicating that we're now looking at it against Medicare wages, where there is no limit, versus Social Security wages, where there were a limit. And so then there's a potential for, do I need to report these things that we thought were the same differently now because they're comparing to one with a wage-based threshold and one without? And some of the inklings that we've been getting so far is possibly yes. So we're looking at, there could be impacts to Form 941, there could be impacts to W-2 already. So there's a lot of questions just on some of the shift of how this calculation or this evaluation of wage qualifications is going to be reported. Some of the information in ARPA indicates that, unlike the originals where we had, like, if you're familiar with the 941, the line 5AI and 5AII, where we were reporting the family leave and the family sick pay, and it only shows the employee portion of Social Security. Now that they're resetting those and qualifying them, information indicates that those wages are fully taxable, but would be reported against the Medicare wage. There may be, it may not be handled exactly the same way on the return, and it may be that the employer pays his share as well as the employee pays their share for the tax, and then we see the credit on a separate line. Yeah, so there's a lot of speculation just based on some of how this stuff has shifted, even though it's what it's still being called what we were relating it to before.
So from a high level, we don't really suspect there's going to be any major changes, right? These are the employers that are eligible. It's the gross receipts test of at least 80%. It's the government shutdowns or partial shutdowns for qualification. It's 7,000. It's 70% of up to 10,000 per quarter,
Right.
aka 7,000. So per employee per quarter. So we don't expect changes to that. The devil's really in the details for how to actually track this, how
Yes.
to get your return, and how to pass an audit should it happen for the minutia of qualified wages as it relates especially to the way ARPA changed the COBRA requirements in how is this going to be reported on the 941, the quarterly employer tax return, right?
Exactly. And we know that with ARPA, they also expanded like some of their I want to say their statute of limitations, because it used to be 3 years from filing date, and they expanded it for these credits and everything to 5 years, which means that they're looking over information a lot longer period of time, to make sure that we did the right thing. And so with that, that's why we really need to know exactly what they're doing, because they increased that statute of limitations to 5 years to assess deficiencies because of the ERTC. So we want to make sure that they're right, because they've got longer period of time to audit and check us. But other than that, because I think it's because they have so many moving targets of all the other credits that are available. They want to make sure, and again, they're trying to ensure that we don't double dip. That's the biggest issue. If you've
Right.
got credit for wages, you can't apply those wages for this retention credit. If you had PPP forgiveness and these wages were under that, you cannot use those against the ERTC. It's just that much. And that is probably the biggest area, I think, initially when they rolled it out, that was so fuzzy that there's people maybe taking advantage that shouldn't have, or fraudsters, which that was a big one for that and PPP. So now they're really looking at how those were handled so that they can tighten those down. So that's the other piece that, okay, so what are we going to do so we can make sure that everybody's guarded, covered, and protected? And I think that's what we've been doing by trying to review this information up front, even before we have the guidance, but having an idea of how to protect our employers so that we're doing the right thing.
Yeah, this is going to just continue to get more complex. I think at the high level, everybody's kind of getting their head wrapped around this. It is certainly a big opportunity for employers, too big to ignore. But the compliance side of this, no doubt, there to be. We are not here to teach anybody how to work around the law. We are vehemently against that. This taxpayer funds that we want to just help small businesses. We're here only to do one thing, that's advocate for small businesses. So
exactly,
part of that is keeping them out of trouble, because I think there's just so much you don't know, right? It'd be so easy to file 941X, that's the amended quarterly return, to get your credit and make all kinds of mistakes in there for qualified wages and whether they're qualified employees and whatnot, without trying. So it's complex. So hopefully this information helps. So with that, I'm looking at the clock here. I'm gonna offer up a resource because this is so complex. We are now offering a service to help clients with this, the Employee Retention Tax Credit Filing Service. If you go to, and I've mentioned it a couple times now, assuresoftware.com /ERTC, you're going to be able to learn all the details of what is the ERTC, the Employer Retention Tax Credit, how much stimulus could you receive. There's an hour video there for you to watch, freely available, also hosted on YouTube, where Terry and I take it 65 minutes unpacking a lot more detail than we did even today. Today provided some updates, and then a form at the bottom if you'd like us to help. So feel free to use this information for whatever purpose. If you want to file your own, if you want to take this information to have a more informed conversation with your tax attorney or your CPA, that's awesome. But if you'd like help from us calculating the information, the qualified wages, if you'd like help actually filing the amended returns to make sure you get your money, we'd be thrilled to help should you need that. Terry, anything else that you want to add before we wrap?
I think we're good. Thank you.
Okay, I'm envisioning, I guess, do you have a sense for timing when we're going to get next round of guidance from IRS? And will there be more on CAA, or do you think we're done and next guidance is going to be ARPA?
I think next guidance is going to be ARPA. I think, I know that there is a clamoring for information. And I know that they want to give us information as easily and as quickly as possible. I hope to see or hear at least pieces of information probably in the next month or so. I'm thinking that they may approach it similarly to what they did for CAA by giving us, here's the first part and here comes the next part. But I'm hoping that there's more than less in the next release, just so that we can get started, because there's a lot of questions that we still have that need to be answered.
Yeah. Okay, Terry, as always, really enjoy talking to you. I always get smarter every time I do. So thanks for your insight. And until next time, thanks to everybody else for joining us today. And if you need any help at all with payroll, human resources, time and attendance tracking, our job is to advocate on behalf of small businesses and then give you the tools to save money and grow your business. So with that, thank you, and we will talk to you next time.